Decentralized finance has promised a financial revolution, instant settlements of payments, 24/7 market availability, and an open and permissionless access. And all of that thanks to the power of the blockchain. Meanwhile, the TradFi world has long been skeptical, not only towards DeFi, but also crypto in general, raising concerns over security, regulation, and scalability. We've all seen that over the past couple of years. And yet we see now Wall Street giants getting closer in touch with crypto, launching ETFs, banks experimenting with tokenized bonds or even stable coins, and in general, institutional investors discovering the advantages of DeFi. These tensions between promised innovation and cautious adoption raising pressing questions: who truly drives this change, who actually benefits from it in practice, and are we moving toward a genuinely open financial system or just a repackaged version of the old one? And in the next 35 minutes, we want to answer these questions. And to do so, we have 4 outstanding voices here on stage, each bringing a unique perspective from either DeFi, TradFi, or the intersection of both. So please give them a warm welcome: Gerry Afentakis, Annelise Osborne, Alex Scharrer, and Alexis Sirkia. Maybe before we dive in, could you just give a very quick introduction, who you are, and what your connection to either TradFi, DeFi, or both is? Alex, maybe starting, or ladies first.
Sure. Hello, everyone. I'm Annelise Osborne. I did traditional finance for a number of years. I spent 12 years as a rating analyst at Moody's, running their structured finance real estate group. And then I got into the space in 2017, 18, or 18, 19 really, about regulation for ICOs, but also really understanding the benefits of blockchain technology for traditional finance. So how can we use the rails of blockchain as the technology and build on top of that? And so fast forward, I'm now at Kadena. I'm the chief business officer. We are a layer 1 proof of work. The real goal that we are working on is really bridging TradFi and DeFi. So we're building out kind of the DeFi ecosystem on chain, and we're also building out the TradFi tokenization side, and there's really a merger of both. I'm happy to talk about that. I also have a book signing tomorrow. My book is called From Hoodies to Suits: Innovating Digital Assets for Traditional Finance. So happy to converse with you after and hopefully answer some questions on this.
Cool. Hi, everyone. Is it working?
I think it's not working.
It will when you keep talking.
It will when I keep on talking. Is it working now? Yes? Okay. Hi, I'm Gerry Afentakis. I am in charge of Europe for Zodia Custody. We're a digital asset pure play custodian owned and used by a number of tier 1 global financial institutions: Northern Trust, Standard Chartered Bank, Emirates NDB, National Australia Bank, amongst a few others. I've been doing that for the last 2 years, and prior to that I was 10, 15 years almost building a private credit asset management business. So I see the world a little bit from both sides.
So I'm Alexis Sirkia. Oh,
I think it's also not working.
okay, it's good, yeah?
It's coming.
It's coming.
It's coming.
It's good, my microphone, yeah.
Yeah.
So I'm Alexis Sirkia, and I'm a software engineer. I used to work at the European Space Center before co-founding GSR, which became one of the largest market makers. And about 6 years ago, I co-founded Yellow, and Yellow is just like you, bridging the gap between traditional finance and DeFi, and we're really about mass adoption and getting retail to use Web3 and crypto.
Let's see if mine is working. Yeah, looks good. So hi everyone, my name is Alex Scharrer. I lead the capital market strategy at the NEAR Foundation. What is the NEAR Foundation? It's the foundation behind the layer 1 blockchain NEAR protocol. I've been with NEAR now roughly 3 years. Prior to that, spent a lot of time in the Solana ecosystem. So Solana is also very dear to my heart. But traditionally, I come from the TradFi industry. I've spent a couple of years in asset management and private equity. So happy to speak about the two worlds, TradFi and DeFi.
Yeah, then let's dive in and start with the first question to Gerry. If we look at recent developments, one could say that the lines between DeFi and TradFi are blurring. For example, we see banks experimenting with tokenized bonds, or even using on-chain settlements, on-chain settlement mechanisms that were originally pioneered in DeFi. would you say that this is the beginning of a turning point for the financial sector?
I think when you see banks experimenting with on-chain settlement and tokenized fixed income securities, what they're ultimately doing is validating what's been proven in DeFi already in the wild, which is that programmable, transparent, 24/7 on-chain settlement is more efficient than the legacy, piping. And so while most of these are maybe pilot projects or still kind of relatively small-scale projects, what we're going to continue to see is that the efficiencies of DeFi rails are going to prove themselves, and the more that happens, I think the more that you see kind of faster adoption from the TradFi world. At the same time, I think what it does is it gives a massive and irrevocable stamp of validation to those builders in DeFi who are seeing the projects that they've been building now being picked up by what was once the enemy and now turns out to be maybe a little bit more the friend. And that obviously spurs innovation. And maybe to come, I think you said something about blurring lines. I think by way of example, maybe what we're seeing, we have simple example. You want to invest in uranium, for example. You have a bullish outlook on uranium, and you're a TradFi person, and you like it as an asset class. How do you do that? You need to buy a spot uranium. That's going to cost you $7 million, probably more than most people's bite size. Or you can buy an ETF. An ETF is very simple. Unfortunately, it's expensive to get in and out. It's expensive to hold, and it trades 6% below NAV. So we have somebody from the DeFi world creating a tokenized real-world uranium asset, the real uranium held in the same warehouses that the ETF uranium is held. It's an on-chain solution. Today, that lives, you need to have your own little MetaMask wallet or whatever you want. You need to find a centralized or a decentralized exchange where you can buy that asset. But the day is not far away where one of the platform aggregators, a Robinhood, a Revolut, an N26, decides, hey, this is an interesting product to give to my client base. Now, where does that go? Does that go in the crypto section, or does that just go in the commodity section? Because ultimately, nobody really cares what the back end and how it's constructed. So my view fundamentally is that the lines are blurring, and very soon will just not really be there at all anymore. It'll just be considered a financial product, and how it's constructed is kind of secondary.
Mm. Alex, maybe one question to you. From your practical experience at NEAR, where do you see DeFi solutions already being used in real capital markets today, and what lessons can TradFi players maybe also draw from these examples?
Sure. I mean, it's funny, like ever since joining NEAR 3 years ago, we've been shouting the institutions are coming, right? Almost like a broken record, but now it really feels like they're here. There are a lot of, I would say, very interesting use cases we're seeing right now, specifically on NEAR. Obviously from stablecoins to tokenization. On the stablecoin side, we see more and more traditional financial institutions adopt stablecoins for payments, especially in emerging economies where you have unstable governments, high inflation, local currencies. Last year we did a partnership with a Colombian bank that is now adopting, instead of using the Colombian peso, they're using a near-native stablecoin for the users to pay each other. That's like one specific example. We've also just done an interesting partnership with a company called Abound. It's basically a financial super app for Indian expats in the US to send money back home and manage their savings, spendings, and investments. And they have already seen roughly $200 million in remittances since launching this. And then obviously we see a lot of stuff happening in the tokenization space. So one of our partners they recently rebranded from Libra to Kaio. They're multi-chain, so they're live from NEAR, Solana, Aptos, a couple of others. What they do is basically provide access to tokenized RWAs on public blockchains. So that includes money market funds, private credit funds, hedge funds, etc. So if you are a crypto startup that just recently raised, or you're a crypto foundation that has a lot of USDC crypto in the treasury, you can now invest directly into these tokenized RWAs without having to off-ramp USDC. And then on top of that, you have a lot of DeFi capabilities as well. So they recently partnered with First Abu Dhabi Bank, which enables them to basically use these tokenized RWAs as collateral for loans. So another area where we see like an intersection of the two, and obviously there are a lot of trends. I mean, I think BlackRock's Biddle Fund is now, 3 billion in AUM. We see a lot of tokenized deposits. We see digital bonds that have T+0 settlements instead of T+5. So I think the use cases are endless, and we are happy to see more and more traditional institutions adopt DeFi technologies.
From Alex to Alexis, if we follow the money, large transactions and institutional products are dominating in the West, while in other regions DeFi is, one could say maybe a lifeline for retail. Who would you say drives this and benefits also the most from this transformation right now?
Yes, a bit like Gerry said, it's not DeFi versus TradFi. And you can think about it like how the pioneers of the internet, they built the building blocks, HTML, HTTPS, and that's DeFi. This is the building blocks. But really the ones that are taking advantage of these building blocks today are, I'd say, the institutions. And just like you had Google and Amazon that build on top of those building blocks of HTML and HTTPS to bring really DeFi, now I think we have the institutions that are going to come and build those building blocks for mass adoption. So the winners are the institutions, but just like Amazon and Google, this might be new institutions, newcomers, not necessarily the JP Morgans, the Goldman Sachs. It might be new players that enter the space thanks to the tools we're bringing to them.
And who do you think is risking in this environment to be left behind?
Who's going to left behind? Well, just like AOL, those that are going to be left behind are those that are trying to build these closed ecosystems where they're not opening to the others. And we've seen it again and again in the history of startups. Those who try to closed ecosystems usually don't work so well. That's why things like Booking.com that opens you to all the hotels, usually Uber that opens you to all the drivers, usually open ecosystems that we see will be the winners. And those that are left behind are those trying to build their own closed crypto ecosystem, AOL style.
Annelise, I mean, we now talked a lot about drivers and profiteers. Let's maybe also talk about some barriers and hurdles. From a TradFi perspective, what are still the biggest barriers to fully embrace DeFi?
Sure. I would look at kind of DeFi two different ways. One is crypto, and like cryptocurrencies as an alternative investment. And I think institutions are actually able now to invest in that, because before it was difficult to own a crypto with wallets if you're an institution. But now with the ETFs, you'll look and see that there's obviously a lot more institutional players buying it with the ETF wrapper. So I do feel like people wanting to either make money or save money, because that's what institutions need to do. We're all profit centers. They didn't want to miss out on the opportunities to invest in cryptocurrencies. So they can do that now. I do think from a DeFi perspective, I mean, that's really decentralization, and I'm happy to talk about how I see that merging. But TradFi, I think, Kim was on the stage earlier and she said uncertainty, and that's the biggest scare for anything in TradFi. You need to have certainty. I think there's 3 holdbacks to institutional adoption. The first is education, is people understanding actually what blockchain is and the rails of blockchain. That's kind of how I look at how TradFi can get into the space. Even before TradFi and DeFi merge, I think the traditional rails should be blockchain based for most things. Like if you think fixed income, that can be automated payments, right? If you look at stablecoin, which is obviously the killer use case, I feel institutions are starting to get into that now. So first, education, understanding what it is and what it can do. Second is regulation. That's the uncertainty bit. That's the clarity. I think Europe has been ahead of the US. The US is really pushing for that now. I was actually in DC for Crypto Week talking to Congress about both the Genius Act and the Clarity Act for digital assets. So I think that is going to help when there's not the concerns of being sued or regulating by legislation. And then the third is interoperability. And interoperability was talked about before as well when we're trying to build on old systems. How do you plug in to the new systems? One of the consulting companies was paid by a client in Ethereum, and they had a partner have their own private wallet. The money went into the own private wallet, so it's actually not at the company level, and then how do you actually turn that around? So they bought an NFT and a work of art. And so it's interesting to think, one, how do the kind of APIs feed in so they're on the accounting systems? How do we build on those old school systems? But then also, how do we interoperate? I believe that there'll be multiple blockchains. And then how do they talk to each other? So I think that interoperability is important as well.
So basically, to sum it up, you'd say there are like security issues, regulatory issues, maybe, and also interoperability.
I think education, regulation, and interoperability. Those are kind of the three bigger holdbacks.
Yeah.
And I think that we're definitely moving forward on that.
Okay. Maybe also to touch a bit more on the frictions, Gerry. TradFi is built on regulation and reputation, while DeFi is more relying on transparency and code. But I mean, we've all been long enough to the space to know that smart contracts are getting exploited basically every month. What does it take for institutions and retail investors in that sense to gain trust towards this new financial tools?
That's a good question. I think DeFi regains trust when code becomes not just something that you can see, but something that you can rely on. For that to happen, certain things probably have to happen in parallel. One is that you need to have strong security standards. You need to have some kind of best practice for smart contract code development. You need to have certification. You need to have code audits. You need to have ongoing monitoring. You definitely need to have some accountability. It can't just be I've created some code and then I don't exist, except in the ethersphere. So you need to have recourse on code that doesn't work. You need to have, therefore, bridges between, I guess, code and legal contracts and the people and companies behind those legal contracts. And then you probably also need to have some kind of a risk assessment for protocols, for the smart contracts themselves, and for everything that surrounds that kind of ecosystem.
And where are we standing today?
So I think, the theory is kind of what I just explained. In real life, things don't really work like that. Where we are today, I would say, is probably easiest explained by an example, right? So you have, I'm sure people have heard, we have this idea of tokenizing fund units. That's great. You can fractionalize a fund unit. You can democratize access to investment products. You can use the blockchain for various advantages. Great. Then, in so doing, you can give, let's just say, a retail investor access to an asset class or an investment class, let's say private credit, that he couldn't do before. Now, with this tokenized fund unit, what that investor can also do is pledge it. I think, I don't know, Annelise or Alex, you said it before, you can pledge that fund unit, that RWA, essentially, to a liquidity pool and earn an extra yield. So all of a sudden, you've created, rather than 6%, let's say, the hypothetical net return of your investment product, you've got 6% on the one side and 4% annualized from depositing your real-world asset into a liquidity pool. So you've created 10% return. So that's clearly a very interesting proposition, not only for the investment manager who gets access to new liquidity, it's great for the retail investor because he gets access to products that he couldn't access before plus a greater return, and it's great for the platform because they're earning money on two different transactions, not just one. However, the big Achilles heel here is it's either a house of cards or it's Fort Knox, and the critical question is how strong is the code of that smart contract where that real-world asset gets deposited. And so you can imagine if you're a Revolut, a Robinhood, an N26, just the names again that come to mind, you have tens of billions of dollars of enterprise value, you have a reputation, you have masses of liability. So you're going to make extremely sure that the liquidity pools that are run by smart contracts into which these real-world assets are going to get deposited, that the code stacks up. So I think we're not too far from that future, and it'll again be the centralized world that is kind of risk managing it and cautiously taking us towards that.
Alexis, maybe to also touch a little bit on the compliance pressure. I mean, we see that more and more DeFi protocols are introducing some KYC modules or some whitelisting or have institutional onboarding, especially if we talk about real world assets. Is this a necessary evolution to achieve higher adoption in your opinion? And who stands to benefit most if this shift takes hold?
So 2 examples. I have a friend. He's building a big engine. It's like a electric turbine. So just these turbines like you have in airplanes, but electric. And the size is 8.5 meters times 2.5 meters. It's like from here to there. And it's huge, you know. And because it's a turbine, you can't make it smaller. You have to make it this big size. There's no prototypes. It's a smaller size because of fluids and whatever. You can't test it smaller. So, and they're gonna place it on top of a helicopter to take people. And he asks me, would you be a user of this? And I said, well, yeah, like this thing that there has been no prototypes, that it's just like real world one-to-one example, this new technology, just like DeFi, you know. Would I like to be flying this? And this is compliance. This is compliance is really like KYC is bringing DeFi, that is this very like technology that is very new, and it's bringing it like you want some standardization, like you said. You want some reassurance for retail that they can travel safely and they can transact safely. And this is really, I think it's in the interest of retail to have this compliance. Otherwise, we will all be flying without the necessary approvals. And you know, like in aviation, the other example is this: who hasn't had GPS? You go with your GPS with your Google Maps, and there's this Google shortcut, and that's DeFi. And then it's a road that it's like not paved, and it's so bad. And then my car got stuck, and I had to call the car, and that's DeFi. You know, it looks like it's shorter, but you know. So TradFi is like this 6-lane highway. It's already established. You have to pay a toll and everything, but you know. So DeFi does bring this reassurance that you know you will get there to the other side. So for me, the beneficiary of adding this sort of compliance layer, KYC, to DeFi is the end user. The end user, you know, it's
for retail, basically.
For retail, yeah. It's
yeah. Maybe if we talk about retail, Alex, just to get your opinion. I mean, we are in the lucky situation to have a very robust financial infrastructure, which works. But maybe from there, like, why should a private consumer turn to DeFi at all? Then at this point, if we have already like an infrastructure that works actually, what would be the benefits?
Yeah, it's a good question. I mean, I think it enables just a lot of different layers on top. I think there's a lot of things that TradFi can learn from DeFi and the other way around. On the DeFi side, I think you have just radical transparency. You have the programmability aspect, which you don't have in TradFi as much. And just the efficiency, right? I think it's not about replacing the traditional financial infrastructure, but I think it's adding layers on top. And I think that's also why in the future I doubt that we will talk about DeFi versus TradFi. It will probably be like one part of the same system, a hybrid infrastructure where maybe on the front end, it will be regulated, but then in the back end it will be permissionless. So I think there's just a lot of different advantages of using both, and we shouldn't, just try to replace all the legacy infrastructure, but see whether we can find ways to add additional layers on top.
So basically, that's touching on the interoperability point that you mentioned earlier. I mean, still, but today, I mean, there are many horses in the race, right? Ethereum and all its layer 2s, Hyperliquid, Solana, whatever. Does one ecosystem stands out to you at the moment? I mean, probably Ethereum at this point, I would say. But how could we like combine actually like all those strengths to have like this one interoperable system that we can rely on? Maybe one question to all of you.
Yeah, I mean, I can kick it off. I think it won't be in one ecosystem. I think Nir believes in a multi-chain world, so I think capital markets will be multi-chain by design, even though some blockchains like to believe that it will only be on their ecosystem. So I think we need to build rails to make sure that there is this interoperability. Because what happened over the last couple of years is you had new layer 1s, layer 2s launch every day, and now it's just for someone that just comes in, the blockchain ecosystem is just very complex at the moment. Liquidity is fragmented, users are siloed, and I think you really need to find a way to defragment that liquidity and really make it easy for the user to really abstract that blockchain complexity away. And obviously there are a lot of different ways to do that. At Near we use chain signatures, basically allows you to sign transactions on various different chains through one Near account. And you don't need to think about how do I bridge assets, how do I wrap tokens. So it just really takes away that blockchain complexity. And at the same time we use intents. I'm not sure if many of you are familiar with that, but basically the way it works is you basically express your intent. Want to swap Bitcoin for ETH, and then you have a solver network in the background that executes that intent for you. So you as a user, you don't need to think about, okay, what's the right bridge that I need to use, what wallet do I need to use, how do I pay in the native gas tokens, etc. All that complexity is abstracted away. I think that's what's ultimately needed if we want to have an efficient capital market. We need a unified UX, we need defragmented liquidity, then obviously we need policy guards on top, AML, KYC. But at the end of the day, we need to find a way to really unify that whole ecosystem. I think that's the way. And we at Near, we don't really play the game of PvP, layer 1 versus layer 1. I think it's just a zero-sum game. I think we are playing the game of how can we really unify all the different blockchains to make it feel like it's one market. And I think that's going to be the future.
I think that's standards as well. Like, I think that I see the world the same. You have two protocols up here. So I do think there'll be multiple chains. I think every chain's going to have its own, not necessarily niche, but things that it applies to or problems that it solves for certain clients or builders or what have you. But I do think that the standards will kind of pull us all together. So I think that that's important to think of. And also the experience, the UI UX, right? It needs to be less clunky. It needs to be much more like a Web 2 experience. So people don't need to know they're using blockchain. They just need to know it's faster, cheaper, more secure.
Mm. And if we talk about like real world assets, could you maybe just tell if it's more like or like what the truly transformative potential of that is? Is it just like a blockchain skin that was like, wrapped around the traditional finance, or how would you view that?
So I kind of started on this before. So if you look at DeFi, which is decentralized finance, right? It's the Bitcoin white paper came out in 2008, and it was at the same time as Occupy Wall Street and the market crashed. And the idea behind it was really getting rid of intermediaries. And so that's really what DeFi does. It gets rid of intermediaries. It allows me to be the bank, and it allows me to lend to Gerry, and we can create our own ecosystem. Traditional finance historically has had a number of intermediaries in between, and generally that's checks and balances and regulatory focused. The idea of regulation is to protect investors. And so I do think there's ways that the two will work together. I think also there could probably be a DeFi ecosystem that may not all be KYC, that survives on its own. But I do think traditional finance can use blockchain as the rails, as I had mentioned earlier, to actually build on. And so I think there'll be tokenized bonds, but maybe those bonds won't be collateral in DeFi. Maybe they'll just be tokenized bonds that are more efficient. If you look at what's working now for everything falls into real world assets. Visa has a data board, and there was $5 trillion of stablecoin transacted in the last 30 days. That is real money, and that is institutions. And institutions are realizing the benefits of stablecoin. I think we're going to get more so when there's yield, right? Tokenized treasuries, instead of me sitting on a bunch of money that I need to stay liquid, I can put that in a tokenized treasury, which is liquid, and I can earn a yield on it. So I think there's a lot of different opportunities that this technology is bringing about. I think we're not going to think of it as necessarily blockchain or crypto later. I think we're just going to think of it more efficient markets. Look at the floor of the New York Stock Exchange today, or 10 years ago, 15 years ago. It was shoulder to shoulder, totally bustling. Now it is empty and it's used for media pictures. And that's not because the New York Stock Exchange is not transacting, it's just because it's been upgraded. So I feel like what we're doing right now with kind of the tokenization of real world assets, or however many want to look at it, between stable coins, between funds, I feel like this is an upgrade to finance. So I It's not tokenized yet, but more retail opportunities in private markets. So I can participate in IPOs now. And this is, I'm trying out all these different platforms. So Robinhood offers you the opportunity to participate in IPOs. Before that was Goldman Sachs private clients, right? You had to have millions of dollars to do that. So I feel like even though that's not tokenized yet, it will be. And the opportunities for me to invest in the Hamilton Lane private equity fund with $500 instead of $2 million or $5 million that I can have access to a private equity fund, that is tokenized. And the cost, being tokenized has decreased the operating costs of that fund, which allow a lower minimum investment to invest in that. So I do think there's a lot of opportunities this technology is bringing to us. And I think that will continue, and we won't, with better, less clunkiness and actually doing it. So kind of this wallet and this chain and what have you, like if I can just go sign in, and see like my crypto and my accounts all together, that's where we're going to get to. And that's where I think, that's the benefit of real world assets, even before I pledge them, right? Just like I have a mortgage on my house, I can borrow against my house, which is an appreciating asset. I can borrow against whatever asset it is. It doesn't have to be Bitcoin. Yes, I can borrow against Bitcoin, I can borrow against crypto, but I'll be able to borrow against other investments that I have because of the tokenization in this aspect of a world.
Gerry, maybe your prediction in 5 years, will we still distinguish between DeFi and TradFi, or will we just call it finance?
Yeah, I think we just call it finance. I think the disruption, everyone sits and we talk about stable coins and RWAs, and it's a great narrative because it's really happening, but the disruption is happening kind of all around. Another example, just because it's more interesting to think about like practical things that are happening today. You have a situation in, I think it was end of June of this year, Donald Trump, he goes to Syria, he befriends new head of state, whatever his name is, and he says, okay, sanctions are lifted, go trade with Syria. But there's a problem. No one can trade with Syria because you cannot. The financial piping to get money in and out of the country has been dismantled. So you cannot just put it back together again overnight, number one. And number two, the banks are still reticent that there might be a regime change again somewhere, and the sanctions will come back. So there's this green light legally to do business with the potential country, and the inability to actually do it using fiat rails. So here there's the necessity to be able to transact, and what is happening is the big commodity traders are going to their banks and they're saying, listen guys, we want to do business here. We still need the same infrastructure surrounding the settlement of a physical trade, right? So I need certificates of title, origin, quantity, quality, all of those literally physical documents that a bank will get, against which it will release the funds of the purchaser of those commodities. But rather than releasing fiat money, they're releasing stable coins. So there's this very beautiful and incremental kind of encroachment of what we call DeFi or digital money, or all the different variations of this new world into existing operating models and businesses that have been around since basically the beginning of time. And that's kind of, for me, firstly, it's a very beautiful and exciting thing. And secondly, to answer maybe your question in long form, it does ultimately eliminate all these labels that we put on top. No one will care. At the end of the day, the commodity guy wants to buy his commodities, doesn't care if he settles in a USDC, a USDT, or a fiat.
But do you see that happening in the next 5 years, or would
For
you
sure,
say?
100%.
Yeah?
It's happening as we speak.
Good. I think I'm done with my question. I would now open, give the mic to you guys. And if you have like some questions that you want to ask our panelists, then now is your chance. No questions? One question?
Guys. Who has a question?
Just raise your arm.
What would you expect the first applications to be which are moved from TradFi to DeFi?
I think payments is first because it's fastest. I had to cash a check. It took 5 days to cash. I just got one the other day. Transferring money to one of my accounts, they say it'll show up in 5 to 10 days. This is me as a person. If I use stablecoins, I get it today. If I'm an institution, I'm not going to float for a few days. I get it today. If I'm transferring money to my, my like another country, it doesn't cost the money and it's an immediate settlement. So I feel like stablecoins are really the first push. If I'm a company and I accept multiple currencies, I don't have to worry about currency valuation and fluctuation. That's where I see the first steps coming through. And then after that, it's more fun.
I think trading is first because changing the core banking system when we went to Avaloq and all these core banking softwares, it's really difficult to integrate a new payment layer because really Swift and everything is really built into. So as a software engineer, when we studied this problem, it's like, that's why Ripple hasn't like penetrated after 12 years still, because really changing the core banking system. But trading is very easy because adding a new trading venue to broker software or banking software is just adding like a new market like NASDAQ or New York Stock Exchange. So now you can add like a trading venue. So for me, we're integrating Yellow Network into core banking software and brokerage software. And I think we're going to be ready before Ripple, that still has like 10 years ahead of us to be able to get that penetration. And really the problem is from the software point of view, adding trading is very easy. Adding payments is really...
You're talking about trading crypto, though?
Trading crypto and using the new paradigms of trustlessness for banks and brokers to adopt. For me, the future, like in 5 years, is not DeFi. I hate DeFi. You know, I hate the word decentralized finance. I mean, traditional finance is more decentralized than Bitcoin or Ethereum. You know, they have there's more banks and institutions than Bitcoin or Ethereum nodes. So I don't know why we call it DeFi versus trade. For me, the future is TradFi. It's finance that we can trust thanks to blockchain, thanks to state channels, thanks to all these trustless protocols that what Bitcoin showed us. We don't need to trust a third party. That's Web3. So for me, the future is TradFi, and TradFi, I think one of the first applications will be trading. We already see it. Yeah.
And if I may add one thing, I think there's just a lot of quick wins for TradFi as well, right? If you talk about settlement, that's just a very tangible business case for them, right? Or instant reuse of collateral. So I think for TradFi, there's a lot of things they can implement quicker. And so also on the tokenization side, I mean, tokenizing like the Hamilton Lane private credit fund, for example, used to be minimum ticket, I don't know what it was, but it used to be like very high.
2 or 5 million, one of those two.
Exactly, and now you can basically gain access to a whole new user group that can invest in those funds. So I think there's a lot of quick wins. I don't know what will be implemented quicker, but those are like some very obvious low-hanging fruits.
Yeah.
Okay, any more questions? Yes.
It's Christoph from Union Investment. Question to Annelise. So stablecoin currently is really a hot topic. Do you believe it's the kind of silver bullet the market needs? And from the investor's perspective, I think the problem is it's non-yield bearing. So it fills in the pocket of the issuer because look at Tether, 13 billion P&L, fantastic business model. But at the end, the end investor doesn't get any penny. Do you think in the US we might step into a more fee-based stablecoin setup?
As in yield-bearing stablecoin in the US? It's a security is one thing, which then requires KYC AML. But most of the institutions are already doing KYC AML for any clients or anyone they work with. So it looks at it a little bit differently, right? Because currencies you can actually trade and it's much faster. KYC adds an additional layer. I do think that there will be, actually I think the Genius Act says we can't have yield-bearing stablecoin in the US. I think that's tokenized treasury funds. I think tokenized treasury funds, when they can be used for cash, I think that's going to be really interesting, as in they can use to transact. That seems to make a lot of sense, and that in essence is like a stablecoin that is yield-bearing. But I don't know that right now they're looking at an institutional perspective from a stablecoin, because I think that the definition, it falls outside for a yield-bearing stablecoin.
Thank you.
Any more questions? Otherwise, I would have maybe one last question. I mean, we talked now a lot about stable coins, but maybe one other topic that I would like to include in this discussion. What about CBDCs? Like, how do you see those central bank digital currencies alongside DeFi and TradFi in the next decade? Which role will they play?
I think there's a lot of countries that are looking into it. I think it's less likely in the United States because there's a big push for actual stablecoin in the US. but it definitely makes sense for some. And what's interesting is they're looking into it for cross-border transactions, which I did not expect, because it will decrease the idea of cross-border transactions. I would think a stable CBDC is internal, but that's what a lot of different entities or nations are looking at it for that reason. I don't know. I don't think banks should all have their own stablecoin. I feel like that goes back to the world, like before we had a national currency. I feel like that's a little strange. I do think there are companies I think there are companies that will become behemoths and and challenge and rival the asset managers of the banks that are in our space. This is not what you asked, but because if you think about look at Amazon and Google, they're one of in the top 10 data companies in the world. They're top 10 data companies, but that's not either of their business, right? That's not their main revenue lines. I think in Web3 we're going to have the same things, and it might be I don't know. Circle's gone public. Maybe if they turn into a bank and they have additional services, maybe they're going to rival JP Morgan, right? I do think things like that will happen, but I'm not sure. I think certain countries will probably do CBDCs. It's like a digital dollar. If you think about digital money now, I never carry cash ever, and it's on a credit card. And credit cards, I use credit cards because it actually protect if there's fraud or if somebody doesn't supply what they're supposed to, then it actually protects that. I think those stablecoins will come to, I think there'll be some user experience similar to that can be done. I think there's a lot of things that we can use blockchain for that we don't, or that we'll find using for that. I mean, Visa and MasterCard are looking at blockchain. Swift is looking at, everyone's looking at blockchain, how to increase their rails. So that's gone on from your question on CBDCs, but.
Okay, I think we're done here. Thank you very much for this insightful conversation, and let's see how that whole journey plays out in the end. I'm definitely excited for that.
Thank you, Daniel.
Thank you.
Thank you.
Thank you.